Hey, what's up everybody, and you're watching the channel where we turn small accounts into massive gains. Are you tired of the 9-to-5 grind? Do you dream of financial freedom, maybe even making $10,000 or more per month just from your investments? Well, you're in the right place. Look, I've been in the trenches trading for over a decade, and for the past 5 years I've been sharing my knowledge helping countless people just like you scale their portfolios on YouTube. Over the years I've learned a thing or two about what works and what doesn't, and today, I'm going to break it all down for you with 3 proven option strategies that can put you on the fast track to $500,000 or more. Now, I know your time is valuable, so if you're in a rush, stick around for the next minute, because I'm about to give you a rapid-fire summary of these powerful strategies. But trust me, you're going to want to watch the entire video for all the juicy details and real-world examples. Let's do this. Alright, let's dive into the first strategy, and that's the wheel strategy. Now, the wheel strategy is all about generating consistent cash flow, kind of like owning a rental property, but in the stock market. Here's how it works. You're essentially acting like an insurance company for other traders by selling put options. Think of it this way. Let's say you want to buy a share of Tesla, but you think the price might drop a little bit in the short term. Instead of just buying the stock outright, you sell a put option. This means you're giving someone else the right, but not the obligation, to sell you those shares at a specific price, called the strike price, within a certain time frame. For this privilege, you collect a premium, which is pure profit if the stock stays above your strike price. Now, if the stock does drop below your strike price, you're obligated to buy those shares. But here's the thing, you're buying them at a discount because you already collected that premium up front. It's like getting paid to potentially buy a stock you wanted to own anyway. Now here's the key. You want to apply the wheel strategy to high-quality companies, the kind of companies you wouldn't mind owning for the long term. Think Tesla, Nvidia, Palantir, those kinds of industry leaders. These companies have a history of growth and innovation, which makes them ideal for the wheel strategy. I recommend dedicating around 70% of your portfolio to this strategy. The wheel strategy is designed to generate consistent income, which can then be used to fuel your other investments. It's like building a solid foundation for your financial future. Now, I've covered the wheel strategy extensively on this channel before, so if you're new here, be sure to check out those videos for a deep dive. But the bottom line is this. The wheel strategy is a powerful tool for generating cash flow and building wealth over time. It's not a get-rich-quick scheme, but it's a proven method that can help you achieve your financial goals. By consistently applying the wheel strategy to high-quality companies, you're essentially putting your money to work for you, generating passive income while you sleep. It's the financial equivalent of having your cake and eating it too. The wheel strategy isn't just about generating income. It can also help you lower your cost basis on stocks you want to own. Remember, if the stock price drops below your strike price, you're obligated to buy those shares. But because you collected that premium up front, you're essentially buying those shares at a discount. Over time, this can significantly lower your cost basis, which means you'll need the stock price to rise even less to make a profit. It's a win-win situation. You're either collecting premiums or buying shares of great companies at a discount. So there you have it, the wheel strategy in a nutshell. Now, let's move on to the next strategy, which is all about maximizing leverage for explosive gains. Alright, so we've covered the wheel strategy, which is your workhorse for consistent cash flow. Now let's talk about LEAP options, which are all about turbocharging your portfolio with leverage. LEAP stands for Long-Term Equity Anticipation Securities, and they're essentially just call options with an expiration date of more than a year. Now, why are LEAP options so powerful? Because they give you leverage, meaning you can control a larger position with a smaller amount of capital. Think of it like this. Instead of buying a house with cash, you're taking out a mortgage. You're using leverage to control a larger asset. But here's the thing, LEAP options have a secret weapon up their sleeve, and that's time decay. See, options have a limited lifespan, and as they get closer to their expiration date, they lose value. This is called time decay, and it works in your favor when you're buying LEAP options. Why? Because you're buying these options so far out in the future that time decay is working slowly against you. It's like having a mortgage with a super low interest rate. You have more time for your investment to grow without the pressure of rapid time decay eating away at your profits. Now, I recommend allocating around 20% of your portfolio to LEAP options. While LEAP options offer tremendous upside potential, they also come with higher risk. Remember, leverage is a double-edged sword. It can amplify your gains, but it can also magnify your losses. That's why it's crucial to be selective with your LEAP option purchases. You want to focus on high-quality companies with strong growth potential. Think Tesla, Amazon, companies that are disrupting industries and have a long runway for growth. For example, let's say you're bullish on Tesla's long-term prospects. Instead of buying shares outright, you could buy a LEAP option with a strike price that's significantly higher than the current stock price. This gives you the potential for massive gains if Tesla's stock price continues to climb. Now, I know what you're thinking. Jonathan, this all sounds great, but how do I choose the right LEAP options? And that's a great question. There are a few key factors to consider, including the delta, the implied volatility, and the time to expiration. The delta of an option tells you how much the option price is expected to move for every $1 move in the underlying stock price. Implied volatility measures the market's expectation of how much the stock price will fluctuate in the future. Finally, time to expiration, as we discussed earlier, is a crucial factor to consider with LEAP options. So, there you have it, LEAP options in a nutshell. Now let's move on to the final strategy, which is all about maximizing returns with option spreads. Alright, so we've covered the wheel strategy for consistent cash flow and LEAP options for leverage gains. Now, let's talk about buying options and spreads, which are all about surgical precision and maximizing returns on specific market movements. Buying options outright can be risky. Remember, options have a limited lifespan, and if the stock doesn't move in your favor, you could lose your entire investment. That's where option spreads come in. Option spreads involve buying and selling options simultaneously, creating a risk-defined trade with limited profit and loss potential. It's like hedging your bets. You're essentially creating a range where you expect the stock price to move, and you're profiting if it stays within that range. There are countless option spreads out there, but for the sake of this video, let's focus on one of the most popular and versatile spreads, the bull call spread. A bull call spread is a bullish strategy that profits if the stock price goes up. You create a bull call spread by buying a call option with a lower strike price and simultaneously selling a call option with a higher strike price, both with the same expiration date. For example, let's say you're bullish on Palantir and you believe the stock price will go up in the next month. You could create a bull call spread by buying a call option with a strike price of $15 and selling a call option with a strike price of $20, both expiring in 1 month. Now, if the stock price stays below $15, both options expire worthless, and you lose the premium you paid for the spread. If the stock price goes above $20, both options will be exercised, and you'll make a profit equal to the difference between the strike prices minus the premium you paid. But here's the beauty of the bull call spread. Your maximum profit is capped, but so is your maximum loss. The most you can lose is the premium you paid for the spread, and the most you can make is the difference between the strike prices minus the premium. Now, I recommend allocating around 5% of your portfolio to buying options and another 5% to spreads. Why such a small allocation? Because these strategies are inherently riskier than the wheel strategy or even LEAP options. Remember, options are derivatives, meaning their value is derived from the underlying asset, and while spreads can help define your risk, you're still exposed to factors like time decay and implied volatility. That's why it's crucial to be selective with your options trades and to only use capital you can afford to lose. Options trading is not for the faint of heart, but it can be a powerful tool for experienced investors looking to maximize their returns. Just remember, knowledge is power. So, there you have it, buying options and spreads in a nutshell. Now let's wrap things up. So there you have it, my top 3 option strategies to help you scale your portfolio from $100,000 to $500,000 and beyond. Remember, these strategies are all about putting your money to work for you, generating consistent cash flow, maximizing leverage, and capitalizing on specific market movements. If you follow these strategies, manage your risk effectively, and stay disciplined, you'll be well on your way to achieving your financial goals. Of course, no investment strategy is foolproof, and past performance is not indicative of future results. But by focusing on high-quality companies, understanding the risks involved, and staying informed, you'll be light years ahead of the average investor. Thank you for watching. If you found this video helpful, please smash that like button, and subscribe to the channel for more insights and strategies to help you build wealth and achieve financial freedom. Remember, the key to success is consistency and proper risk management. Happy trading!